Now, last week's volatile market swings prompted a lot of talk in the Valley as some of the hottest tech companies prepare to go public. Venture capitalist Geoffrey Yang of Redpoint tweeted, "The sound you just heard was the IPO window slamming shut." Benchmark Capital's Bill Gurley responded, saying, "I think this is simply not true, and I respect Mr. Yang." Gurley added some color, saying, "Great companies don't need a hot window, only not so great ones do. Yelp, Facebook, Dropbox, and many others could go mañana, or tomorrow." Geoffrey Yang himself is here to respond. At Redpoint, he's invested in Netflix, TiVo, and HomeAway, which just IPO'd. Welcome back to Bloomberg West.
Thank you.
So making waves out there, you know, a lot of people in the comment section agreed with you, others did not. Do you stand by what you said?
Well, I didn't quite expect that the tweet I put out would engender so much reaction, but I was speaking more about the fact that the IPO window and the IPO market was going to get soft because of all the volatility and the uncertainty in the market. And I think what happens is in times of great uncertainty, people kind of fly to quality. And they go to quality in terms of gold, they go to quality in terms of treasuries, and they go to quality in terms of companies and the tried and true names. And as a result, people tend to move away from things that they perceive as less speculative. But I think over time, certainly I think the IPO window will come back. And I think Bill Gurley's comments are exactly right. I think there will be a market for companies that create a lot of profits and create a lot of revenue growth. And I actually think that over the next few years, 5, 6, 7, 8 years, I actually think the IPO market for the right kind of technology companies is actually going to get stronger.
So do you think if Facebook or Dropbox went out today, they would be just fine?
Yes, I think they could go. They may not choose to go in the current market environment because I think with the uncertainty, while there's so much volatility in the market, people are going to, and until people know what the new normal is, people will try to stay with the tried and true kind of larger industrial names. But I think over time, as soon as the market settles, people are going to start looking again to growth on a revenue line and, more importantly, growth on a profitability and a cash flow line.
Now, I want to read you a tweet from someone who tweeted to both of us when they heard you were going to be on the show. Todd Heberlein says, "If the IPO window is shut, who is hurt the most?"
Well, I think what will happen is that the companies that have real revenue growth and real profits, let's say a Zynga, I think they could go public at any time. They may not choose to go public because the valuation will be lower because people are kind of staying away with the current environment, and they may or may not like the new valuation environment that's currently in the market. So I suspect that the people who don't need to go, will probably wait till they get a little bit more visibility going forward. The companies, however, that will get hurt are the ones that really need to raise the cash in order to kind of keep going. And those are the ones where they're accessing the public market for funds to prove out their business model until they can get cash flow positive.
And any examples, any companies in particular that would come to mind?
Well, I think any company that's not profitable or generating cash probably falls into that category.
So how about Groupon? Groupon and Zynga have both filed. Groupon is not profitable yet.
Right.
Should they wait?
Well, I'm not involved with Groupon, but just looking at their financials, they consume a lot of capital. Obviously, it's an unbelievably large opportunity, and there's a lot of buzz around the company. But the fact of the matter is they're still consuming a lot of cash, and they need to finance that growth somehow, either through the private markets or the public markets. And so I would say they're a company that probably is more on the spectrum of needing to raise money, whether it's in the private market or the public market. I'm sure they have options to raise in either market, but they may decide that independent of the valuation, they want to raise the market. So they want to raise the money.
If Groupon IPOs in the next couple of months, is it not going to be? It's not going to look as good, as if they had IPO'd a month ago.
Well, in some respects, people will say, what difference does it make, when they go public and what the valuation is? Because it's really ultimately what the long-term value of the stock is, and whether a company goes public a little earlier or in a down market or a little later in an up market doesn't really matter. My experience with entrepreneurs is that they feel there's a fair price for their stock, and they want to get the best and fairest price.
Quickly, is there air coming out of a bubble here? Is this what we're seeing?
Yeah, I think there is. You know, I think valuations have gotten very lofty and possibly a little ahead of themselves. I'm a big believer in the long-term fundamentals, but I think that the valuations got ahead of the fundamentals, and it's not necessarily a bad thing.
All right, Geoff Yang.